This is one from Emidio. It's a good question. They're all good questions. But he says, when searching for a married put, now from scratch, not trying to protect another position, shouldn't we consider the probability above and or the percent ratio to break even and consider these parameters in the function of volatility? My answer to that is yes and no. The only thing I pay attention to when opening a married put position is going to be the percent implied volatility range. Let's go to married put real quick. And as you guys know, let me go back here very quickly. I'm sorry, let me go back here. There we go. The married put approach we advocate, you sort of saw a hint of already. It's what's talked about in the blueprint known as the radioactive trading techniques. I like to buy a put that's 150 days minimum. My average is probably 210 to 240 days out in time when I open a new position, and it's slightly in the money to keep the risk in those single digit areas. Okay, now, why is that important? Well, that's what we show here in the basic search. The first default search under married puts is the radioactive sorted by earnings per share growth. 95% of the positions that Fusion subscribers see in a radioactive trading account where Ernie and I post our live radioactive married put positions come directly from this default search list. And you can see the criteria here over on the side. Now, I'm going to change some columns up for us real quick. I'm going to take out delta, implied volatility, gamma, theta, vega, rho. Leave all the others in there, most important, maximum risk. And I'll put back in the percent implied volatility range Emidio as well. All right, let's go ahead and submit that and close the window. Now, by the basic rules that we look for, I don't want to take a risk personally of greater than about 8%. My range is usually about 3 to 7.5%. And I'm never going to go more than 20% in the money. And okay, so also based on my account size, I'm only going to look for positions in the fundamentals that have a cost base of less than maybe $85, $90 per share. That's me personally. Doesn't mean it's any better or worse. And here's the trade I entered yesterday for the Fusion subscribers. And I actually sold a call against it right away for September. It was only 8 days to expiration. Agnico Mines, my cost was $83.75, and I bought the September 90 put for $14.30. In any case, what I do look at here, Emidio, is in general, I definitely don't want the percent implied volatility range to be above 70 or 75%. What does that mean? That means where the option's implied volatility is now compared to what it has been over the life of the option. Normally, I'd have this less than 50%. We're still not in normal volatility market conditions, are we? So I've upped it to 75. Okay? Now, pretty much all the same ones are still in those positions. So you see here, the AEM position that I got yesterday was a little bit less. It was 8.4, 8.3% of the money when the stock was at 83.75. Do I pay attention to the range in the money, Emidio, for what you're looking for as an expectancy? Well, yes, I do. Because I don't want to necessarily go more than 15% in the money. JD.com risk looks really great, but unless I have a strong expectation that JD would move up 18, 20, 25% in the next 60 to 90 days, not 189, but in the next 60 to 90 days, I don't think that's a good trade-off. This is also discussed a little bit in the blueprint and in some of our conversations on the webinars. These are great targets here, I think. 9.5% because I have an outlook for AEM that's beyond that. And I can be wrong, which is what? Which is why I'm buying a put option in the first place. The implied volatility range is higher than I want, but with certain things coming up in November and the unknown of what's going on around us, I have to accept that right now. Okay, I have to take that into account. Are there better ones here? Yeah. Bank of America, Silver Wheaton, Wheaton Precious Metals, old Silver Wheaton, Ernie's in this married put. They have a lower IV range of 26%. They've got good risks. Why didn't I open these two? Well, right now I'm not really confident that the banks are going to see amazing growth in the next 60 to 90 days. Personal preference, I could be very wrong. But Ernie's already in the WPM position. That actually hindered me from going into it because he's already posted it to radioactive trading. So I went with something a little bit different and I went with AEM, and I was also looking at DHI, and SAIL was in this list earlier, SAIL, at around $39 per share. Okay, but to your point now, I mentioned the implied volatility range that I want to focus on. I don't want it to be at 80 or 90 because if something unexpected happens and the IV range drops back to where it was at 30 or 40% of its total range over the life of the option, the stock didn't move, and I might lose 2 or 3 points on the put. I don't want that to happen. That can put you in a bad spot. So that's one of the filters I'll occasionally use. Let's talk about some of the lessons on radioactive trading in the blueprint as well. Now, you had mentioned other ideas about the implied volatility and using that as a projection of where you think the stock's going to go. Normally, my first step, once I have the search and have my results, is I just take a look at the chart and I say, what is my expectation? The stock could be trading at or near $90 in the next 30 to 50 days, 30 to 60 days. And I felt confident with this. But again, I can be wrong, which is why I have the put in place. Now, let's go back to add or remove columns. And we'll add back in delta, implied volatility, gamma, theta, vega, rho. Okay? We don't need to go through what each of these are. Some of you, of course, many of you know what these are, some of you don't. Why am I not worried about doing this mass calculation in Emidio of expectancy with playing around with the implied volatility versus the stock price versus the delta versus where the gamma is, and how would the gamma change with a 1-point movement based on the delta movement? I'm not filtering by any of these criteria. But as we always show in these webinars when this question comes up, even though I am not screening by delta, gamma, theta, or vega, or implied volatility, because of the other criteria to have the risk I want, the range in the money I want, everything is already filtered to a limited range. My deltas, 0.53 to 0.63. That is a pretty restrictive delta without even using delta as a filter because everything goes hand in hand. In order to have that risk less of 8% on a quality stock with good movement, good lower volatility movement, and being less than 15% in the money, we're probably assured that we're between a delta of 0.54 to 0.65, 0.68. Don't need to filter by delta because we already are without using it. Look at my IVs. Lowest is 0.3291. Highest is 0.4651 with JD.com. The gammas, they're all within a very tight range. It looks like 0.02. Oh, no, this one is out of bounds, but that's okay. 0.0653, which is out of bounds, but all the other ones are between 0.022 to 0.015. Very tight range. Same with theta. Same with vega. Same with rho. And this is also true if you put in a, we'll get in this conversation soon, of course, related to covered calls. But in this scenario, when I set up the structure to look for what I want, let's say do a covered call search where I want 30 days out, minimum return of 2.8%, minimum downside protection of 5%, well, I'm looking right at or slightly in the money to get those numbers. That's just logical. That's the way the strategy works. That's the way the market pricing works, which means my deltas, gammas, thetas, and implied volatilities are all going to be relatively the same without even using them as a filter. So more important to me, Emidio, I don't get into that big equation of trying to compare the implied volatility of my position to my range in the money and my risk to decide what's my expectancy of profit in the stock hitting there. I'm already filtering by these, so I know they're pretty close, and I'm finding a position that I think is in a sector and has the performance view that shows me that more than likely this stock has the potential to reach where I'm expected to get, to reach the strike price of the put within the next 20 to 30 days, maybe a little bit more, 20 to 45 days. Okay, so that's how I approach it, Emidio, in relation to that. We covered this a little bit last week for Mark. I'm sorry, not for Mark, but this question is for Mark very quickly. We covered this a little bit last week. He asks, what is your favorite method of hedging the tech portion of your portfolio? Last week, we discussed, I'm going to go to long calls. And we discussed protecting the different hedges we might use on a long call portfolio. And so here's our 5 or 6 long calls that we entered. Some of them are at a profit, some of them are at a loss. But most 3 are at a profit, 2 are at a loss. The best hedge in this case that worked out, these were mostly against SPY, but the best hedge in this case was the direct put for SPY. The VIX calls didn't do much for us. They're not too far up. They went really high at the moment mark. Remember, think about the VIX back on Thursday or Friday of last week. It went up to about $28 or $29, but now it's back down. We only have a 5% gain. I'm sorry, those are shares of UVXY. I apologize, Mark. Those are shares of UVXY. The highest I think this went to is 25 or 26. The VIX calls at 26.87, their high went up to 28.29. And so those were profitable. But in the webinar last week, we saw that the 5 long calls we would have entered on August 24th or on August 31st, the best return was the out of the money direct put approach for the portfolio. By out of the money, I mean around, I think I said a 0.3 delta is what we looked at. So we were looking at, now it's right at the money, but at the time when we bought the puts, we were looking at a lower 0.3 delta for protection. And that's when we saw the market up at those higher prices, when it was at 345, 348, and 350. The 3% delta was the October 334, about 35, 40 days out of time. You can see here, this gave the highest return in that situation. So in general, let me pause on this for a minute. Let's just go to big charts again. My apologies there, Mark. Let's go to big charts. All right. So we did 2 scenarios. We did if we bought on or around August 24th, which was good because we had some gains before the plummet happened, and around August 28th, right when the plunge started, in which hedges worked best. If you caught the peak, in this case, even in this case, if you caught the peak, it still did look like the direct put was the best hedge. And so in this case, if I was heavy on tech, whether it be bull put credit spreads, calendar spreads, covered calls, neutral to bullish positions, Mark, I'd say about QQQ might be the best hedge. Frank, I didn't check and compare QID or SQQQ, the ultras. I will do that. I'll look at the historical price and we'll compare that later. But I didn't do that. But a lot of times when I look at the ultra shorts, they get a higher return, but then you also have to pay the higher price to get into the position. It's almost an even trade-off. It depends. Was this a huge decline? No, it was about 7 or 8%. Well, it's pretty big. No one wants to see that if we're bullish to neutral strategies and you're betting on bullish positions. I understand that. But this was not what we saw February 25th to March 3rd, March 3rd to March 10th, March 10th to March 20th. This was not the decline we saw from February 5th through 9th of 2018, where my VIX calls that I had when we talked about it back then, using the VIX calls as a hedge for a potential volatility spike, more than paid for the loss I took on the 3 bull put spreads that would have had to have been closed at a 49% loss of the maximum, because the VIX shot up to almost 60. And in March, the VIX shot up to almost 90. UVXY almost shot up to the same price, $76, $77. Yes, SPY dropped a lot, but those values in the VIX, what are you getting? If I bought a VIX call, and I had a couple, but if you got into a VIX call around February or around January with a March expiration, not only did you get that massive influx of price swing on a VIX call from whatever it was, 16 up to 90, or calls on UVXY, the implied volatilities also increased. It was great. It was a fantastic way to hedge. But for smaller movements and gradual movements, these were only what? I think the biggest drop was 6% or 4.5% in one day, and then another 2%, then another 1.5%, and so on. With these types of gradual moves and it starts to settle, the direct put is the best play. It really is. Because this would all be doing a VIX or UVXY. Let me clean up that drawing, Mark. That's not going to help you. But doing that for UVXY, you'd have to catch it at the exact bottom, because once it went back up here, you probably gave up 30 to 40% of the profits you had at this mark. It's very, very fast. whereas the puts on the ETFs are a little bit more continuous, and possibly the puts on those other positions would be very good as well. All right, so let's go back here, and all that being said, I don't know if we had any questions, any topics here related to this, but Sam popped in about 20 minutes ago. I just didn't see him. He says, hey, good afternoon, everyone. Had some work to take care of. Sorry that I'm late. Hey, it's great to see you, Sam, here. You're talking about ITB is up 22% this week, I believe. The Contra ETF is up 25%. And so that relates to the comment that came in that said, would you hedge with SQQQ? I think Frank said that when we were talking about hedging the technicals. Would you hedge with SQQ or potentially QID or one of the other ultras? And we didn't have the data on that. We're going to look that up later. You also mentioned NNOX is up. And you say you bought Apple today and Tesla. I don't know if you bought straight stocks or if you're doing that and you're thinking about selling calls in IWM, SPY. They're all positive results. And you were selling calls. You were only in the trade for 2 to 3 days because you don't want to be in too long. Because when the reversal will come, it will likely be a huge one, in your opinion. Okay. All right. So you're selling calls against the shares, the IC shares that you own in that case, but you don't want to miss the, you want some protection there, but you don't want to do that as well. Okay. All right. David says, had to roll at 5:55. Great session. Thanks for doing these, David. You're welcome. Thank you for your question via email. I'm glad we got to handle that for you. Sam says he also didn't do a bull put spread in Apple at this stage this week. Probably a good idea. Luckily, my bull puts did all expire worthless. We'll look to open new ones soon. Said your last SP in Apple was number 14, which ended up in the money. Okay, so your last BP bull put there as well. Okay. All right, Frank, you had an earlier comment, and I'm not sure how I can address this. You said an MS bull call spread 50 to 50.35 stock repair tool. Well, in order to analyze that, I kind of need to know what cost basis that you used on MS for the stock repair. Let me just see where MS is now. How would a 50 to 50.32.5 work? MS is at 50.35. Okay. So the stock repair tool, again, helps you build a ratio call spread to help you get back to break even faster. And let's say my cost basis was 55.10, just throwing it out there. Might work with that spread that we saw, 3 points. Okay. 50 to 53.5. Didn't come up. Okay, so let me lower my price range here. Okay. Well, it's not showing me the spread that I want, so I'm just going to go. No, that's a 52.5. I'm sorry. I'm just going to go ahead and build a custom spread. The stock repair tool, what it does is when you put it, when you put in a price of your stock, it's going to try to build a repair for you. So let's say 100 here at, okay. Here we go. All right. So, I'm sorry. What was I doing? 55.10. And let's say here, I'll do probably have to go out to November. Oh, those don't have it. You have to do a weekly. I get you. All right. So 53.5 and a 50. Well, this one isn't going to work if I buy one and sell two. So the whole ratio structure is designed that you want to buy one and sell two to help you get back to break even faster. But this should really be done at a credit. And sorry, I did that reverse. I should have just changed the symbols. That was ridiculous on my part. So the 50 here at 182, what I want to do is get at least 90 cents. And I'm not getting it at the 53.5. It'd have to be at the 52.5. So if I did it at a debit, which I prefer not to do, let's get it right this time, Mike. You buy one, you sell two of the higher strike. All right. This does get me back to break even faster, but it didn't appear because it's done at a debit. I'd only get 114 back, and I'm paying 189 for the 50 call. And this is for the October 2nd series. So I'm doing it at a debit of 70 cents, which sometimes isn't bad. But it put my break even at 52.92, which is really good because my cost basis was at 55.10. But that's still a good range out of the money. where the system probably didn't build this particular debit spread because the break even was still too far out of the money potentially. Yes, it could get you back to break even faster, absolutely. Instead of needing it to go back to 55, you could see it at 52, 95. And this is a reasonable repair, but I prefer not to do the debit repairs. I had this conversation earlier with a customer as well. Why do I not like to use the debit repair? The one thing this position does not do is address the downside if the stock keeps falling. I had a cost basis of 55.10. Now my cost basis is 55.85. So if this trend continues, Morgan Stanley drops down to 49, 48.50, I'm not only still losing money on my 55.10 cost basis, I'm losing as these three calls are getting further out of the money. Yes, I'm keeping the premium, but this one's going to zero, so I'm losing that additional 85 cents as well. The debit repairs can get you back to break even, but you have to ask yourself, is it worth it for the extra debit if the stock continues to move against you and fall down, because this doesn't address the downside. And when you do it for a credit, yeah, you get a little bit more downside protection. You get a little bit better break even in that scenario because the premium was collected. But in this case, with the 50 and 53.5 strikes, it looks like all of them would be done at a debit. This near-term one, if I had a cost basis on MS of 55.10 of October 2nd, is only a debit of 85 cents. But again, it's because it looks like the break even is still 3 points roughly out of the money, about 5.6% out of the money from where you are now. That's why we might not have been seeing them as debit repairs that could be calculated for October as well. Okay. And also, one other thing to mention here is that this is a debit of 85. I'm going to be honest with you. We know that we come in here into the spread tool. This is showing us at midpoint. I believe the initial stock repair is basing it on natural bid and natural ask. So the debit's even higher. Okay, we're going to be, well, not too much higher. It's only about 8 or 9 cents higher. But we're going to be looking at an additional debit of 60 cents. Well, that's not right. So I did it backwards. I'm selling. Wow. Okay, you can tell it's the end of the webinar on a Friday. I was selling this for the bid of 53, and I was buying this for the ask of 191. I did it reverse. So now, yeah, we don't get it that 82 cents. We get to 95 debit. Okay, so we're taking it up to a little bit higher. Okay, 75 instead of 95 there. Okay. All right. Let's see here. Okay. Okay, but the stock repair tool is very powerful for various positions. Again, on the webinar section, once more, I just want to mention, if you go into the Power Options tools from a few months ago, here's just a quick, more in-depth 5 minutes on the stock repair, how that structure works, why I would look for a credit over a debit. But at times, a debit spread repair, if it's built, can be very powerful in that case as well. Real quick, Sam.to's pen was at $6 and TUP at $2. They both went up huge. The price I put was in March sell-off. I did buy them at that price. Excuse me. All right, price. I put AWS in March and sell. Okay. Still holding them, good number of shares. Yeah, I saw that run on pen. That was a married put I had several years ago, a few years ago. In that case, and then you also mentioned FNGU, bug there, FNGU there at that time. Also looking at that one as well. We entered that new married put on AEM. Did go the opposite direction the day after I opened it. It was bouncing around the first day, and then it did go down in price. But because of the structure, we did it as a married put, and I sold the call right away because it was only 8 days to expiration. It gave me 75 cents of premium for 8 days on a $60 stock. I'll take that. 1% yield, 1.4% yield. I'm sorry, a little bit less than 1% yield for 8 days. That was more than fine. Oh, there we go. Yeah, but AEM dropped down again at 83.75 cost basis from yesterday. It's down $1.57, but I've made 60 cents on the put, actually a little bit more, and made 40 cents there. So gained almost a little bit more than $1 back on the position in the first day. So we're only losing 60 cents on the whole position. with it being down about $1.60. So that's sort of the fun of those radioactive trading techniques and so forth we discussed yesterday, earlier in the presentation. All right. Well, ladies and gentlemen, we are at 6:04 p.m. Eastern Time, and I don't see any other questions coming in, or any other questions or comments are coming in. I think I got through all of Sam's, who came in late, and as well, and we took care of all of David's, and finishing up some of Frank's questions there. I just want to remind everyone that today's material, my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do involve risk and may not be suitable for all investors. If you did like some of the tools that we saw today, we walked through that stock repair tool. We walked through the insurance tool at the beginning to talk about hedging, that block of IWM shares for David. Didn't look at the portfolio tools and the management techniques much today, but there's full webinars on those. We talked about a lot of strategies and the power of that patented search tool for some of the different strategies we looked at. Well, you can test them for free. There we go. You can test them for free at any time. Just go to powerup.com, put in your name and email address, and you'll have full access to the site for 14 days. After that, subscription services start at $45 per month for the end-of-day data. We do also offer a delayed data service and real-time, of course, for higher costs over the regular subscription. The most popular subscription is probably the 20-minute delayed at $65 per month. Now, as mentioned, you can check out the webinars page at any time. Just go to powerup.com/webinars.asp, and you can go through the different content there. And also, of course, you can check out our YouTube channel where most things are posted, as well as the blog. Now, sorry for the spacing here. One of the things on the new computer is I've been using a lot of these presentations using OpenOffice just because it was simple and easy to use. And the new system here already had all the Microsoft stuff in it. So converted an OpenOffice into PowerPoint, and it didn't like it, and I forgot to check the final slide. But in any case, you know the drill. If you have any questions, send us an email at any time to support@powerup.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And of course, if you're on a trial or a subscriber, you can schedule a coaching session at any time. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. Good point, Sam. I had slipped my mind. I actually had it in my notes. One part of yours, not the other part. Remember, next week, we want to pay attention to Wednesday because the Fed is going to do some announcements there and make some discussions. So that might change the market. It might have an effect on the market with what they decide to do. And also Thursday, Moderna has earnings, Sam points out. I don't know if I'm going to play Moderna's earnings because it's extremely volatile and the cost is very high. And I don't want to take a risk of a short one way or the other. And it's hard to gauge what those earnings are going to be because they haven't really been doing anything other than speculation of what's going to be potential for the vaccine, of course, which would be great news if that came out very soon. But we have to be patient because we don't want the wrong type, a non-working vaccine, for lack of a better term, in that situation. But it's going to be interesting nonetheless to keep an eye on the market this coming week and see what we have with the Fed coming up, some of the Fed talk, the Fed meeting, and see where we're going to go from there. Ladies and gentlemen, thank you once again for the spirited discussion. As always, I'm going to start cropping some of this. I'm going to start cropping the material apart there, put them into different sections. David's full section, of course, will be just one full big section of that 25 to 30-minute conversation. We'll have MK and Jesus's conversation and possibly likely William's conversation lumped in there. And then we'll put the other William question in. We'll have those in those different sections also, put them all together so they're like material. We'll post them to the archives on the webinar page that we mentioned, as well as to the YouTube channel. You will all receive an email when those are released. Sam, I'm sorry you were late, but thank you for joining us and for your comments. Sam says, have a great weekend, everyone. Take care, be safe, stay 6 feet apart, and wear your mask. You too, Sam. You stay safe and stay healthy, as well as everyone else in the room. We'll see you later next week for another presentation, and I'll let you know again when these archives are available. Take care, everyone. Have a good, relaxing weekend. Stay safe, stay healthy. We'll see you soon. Good night.